Hi, good afternoon, everyone, and welcome. My name is Oscar Valdez Vieira. I'm a senior policy analyst for capital markets and private equity with Americans for Financial Reform Education Fund. Thank you for joining this webinar. This is part of AFR's guest speaker series. As they say in the podcast, we have a great one today. We will be talking about a major shift in American finance, why fewer companies are going public, while private markets have grown massively in size, in influence, and political power. Uh, all of that raises very important questions about what happens when companies can grow to a really massive scale while avoiding disclosure, governance, and the market and shareholder discipline that comes with being a public company. And why should that matter? Not just for venture capitalists or securities lawyers, but for everyone, workers, retirement savers, and the broader public. So to talk to us about that today, I'm very pleased to be joined by Renée M. Jones, Professor of Law, and Dr. Thomas F. Carney, Distinguished Scholar at Boston College Law School. Professor Jones is a former director of the Securities and Exchange Commission Division of Corporate Finance, and she's also the author of the forthcoming book, Untamed Unicorns: Why Startup Finance is Broken and How to Fix It, which will be published on August 4th and is already available for pre-order on Amazon and some other outlets. Professor John, thank you so much for joining us.
Thanks so much for having me.
Yeah. So we're a couple of minutes past 2, so I think it should be fine. Shall we dive in?
Sure, go ahead.
All right, so let's do a little bit of table setting,
Okay.
and if you could talk to us a little bit about, it would be helpful for a general audience to know what capital markets are and what are some of the differences between public and private markets.
Sure. So just to cover the basics, in public securities markets, stocks trade on public securities exchanges like the New York Stock Exchange, and prices are set in daily trading, active daily trading through impersonal transactions. Um, Public companies make regular filings about their finances and their operations with the Securities and Exchange Commission, and that information helps inform investors' decisions. So that's basically the public markets. So if you've ever bought stock or traded stock, it's probably been in the public markets on the New York Stock Exchange through a stockbroker. Private markets, by contrast, are very different. In the private markets, companies issue securities without registering the transactions with the Securities and Exchange Commission. They don't provide standardized disclosure documents to investors or the public. And generally speaking, at least, these markets are opaque. They're illiquid, meaning it's hard to sell securities if you've bought them in the private markets. And the valuations are subjective. That is, they're determined by fund managers and not through arm's length transactions. So with respect to private markets, we can divide them even further into different categories, which are based on the investment strategies of the funds that dominate the market. So venture capital, or VC, which is the subject of my book, invests in early stage companies. They take minority positions in these companies, and they guide the companies through various stages of growth toward an exit transaction, which would typically be an initial public offering or an IPO or a sale to another company. Private equity funds is another form of sector of the private markets. Private equity funds purchase entire companies, either public or private companies. Usually they're borrowing most of the funds to make those purchases. And then the private equity fund managers seek to improve operations by either cutting costs or other measures. And then they want to bring those companies public or sell them to another company. So that's the private equity sector. And then we have private credit, which is a rapidly growing sector of the private markets with about $2 trillion in assets. And private credit funds basically act like banks. They loan money to private companies that might have trouble getting loans from traditional banks. And although they act like banks, private credit funds aren't regulated like banks. They're not subject to bank regulation, and that allows them to take on greater risks. So over the past 30 years, the private markets have been expanding while public markets have been shrinking basically pretty rapidly. So I'll just go through some background data. The number of public companies has decreased from about 8,000 in 1996 to about 4,000 today. The number of IPOs, initial public offerings each year, has also fallen from a one-time peak of 700 in 1996 to 350 last year. And three times more money is raised in private transactions, unregistered transaction, compared to transactions that are registered to the SEC. Startups are staying private for much longer than before. For tech-based startups, they used to go public within about 7 years back in 1996, and that's moved to about 10 years in 2024. So as a result of all these changes, we've seen that the number of billion dollar or multi-billion dollar private companies has grown dramatically from about 40 in 2013 when the term was just coined to about 1,500 today.
So the public securities markets have been, or at least used to be, the central engine of capital formation in the US, right? And
Mm-hmm.
since the end of the New Deal, and very central to the economic success of of this country after World War II. Um, and successful startups generally entered that system by going public after a certain point. So can you talk to us a little bit about what you were saying? You know, very large companies can stay private now for years, even decades. What changed? What made that possible or even attractive for some firms and founders?
So there have been a number of changes. I think most of the changes have been spurred by some important legal reforms. So I'll just talk a little bit about those. So it used to be, as I just mentioned, that startups would go public within 5 to 7 years after they were founded. These are successful startups, and that's because they needed money. If they did need money, they would have to go to the public markets to get the money that they needed. And also, even if they didn't need money, there was a provision of the law. Section 12G of the Securities Exchange Act, and that law at one time, up until very recently, required that any startup with 500 or more shareholders had to register with the SEC and become a public reporting company. So companies like Microsoft, Facebook, Google, they all went public because of that change, that law. So those laws have changed. There are two major laws that most people probably haven't heard of that's changed this dynamic. So the first is in 1996, Congress adopted the National Securities Market Improvement Act. We call that NSMIA. NSMIA eliminated the legal cap on the size of private investment funds. So now funds get to be any size, and we have many multi-billion dollar private investment funds. So private investment funds include VC, private equity, and hedge funds. So after this change in the law, private markets just grew really dramatically from about $200 billion in assets in 1997 to $9 trillion in 2024. That's according to PitchBook data. So with this change, with all this money in private markets, it turns out that startups could raise most of the money they needed in private transactions and no longer had to tap the public markets to raise the capital they needed to grow. That was one change in law, 1996 NSMIA. And then in 2012, Congress adopted the Jumpstart Our Business Startups Act of 2012. We call that the Jobs Act. That's the law that eliminated the provision that I mentioned, that startups register with the SEC when they reach a certain size. So what the Jobs Act did is it replaced Section 12G's 500 shareholder rule with a new 2,000 shareholder limit, and they also excluded employee held shares from that count. So then after the Jobs Act, startups could stay private essentially indefinitely. And the median age at IPO expanded from about 9 years in 2012 to 14 years in 2024. And so that's why we've seen, this great increase in the number of unicorns, as I've mentioned, from 40 when the term was first coined, because they were very rare, to, as I mentioned, 1,500 unicorns today.
And so can you talk to us a little bit about what either the rationale or the excuse behind these laws and these changes, both, like the Jobs Act that you were mentioning, or other actions by the regulators, and what's the story that's usually been behind these changes?
Well, I would say that sort of most of the deregulatory provisions of the securities laws have been justified, at least through in the rhetoric, by the argument that on the securities laws, the regulations, the rules are very technical. They're making it very hard for companies to raise money. So most of these arguments focus on the difficulties that small businesses have raising money in the market, the money that they need to grow. So that's sort of the mantra that's behind most of these securities law reforms. More recently, what we're hearing is that there are not enough public companies. Private companies are avoiding going public, and it's because of too much regulation. But my work kind of shows that it's not the regulations that are preventing companies from going public. It's the deregulation that's basically leading to this change.
Right. Can you talk to us a little bit more about that? What else does the overregulation story misses?
Sure. So the book really documents a steady trend of deregulation of securities markets that began back in the 1980s during the so-called Reagan Revolution. And that trend has just continued apace today. So these reforms kind of all working together have really made it much easier for startups, as we've already discussed, to raise huge sums of money, multi-billion-dollar transactions in private markets. And also, importantly, for their investors to sell their shares to other investors without registering those transactions with the SEC. So working together, all of these reforms have essentially eliminated the urgency of a public offering, either to raise capital or to allow investors and employees and founders to sell their shares. So I review this long history of exemptions going back in the 1980s, and it really shows that each of these exemptions started out fairly narrowly. Like, we're just going to make things a little bit easier for small companies to raise money. We're just going to make it a little bit easier for small companies to give shares or sell shares to their investors. So, the rationales that were put forth to justify these exemptions sort of made sense over time, but as these exemptions expanded, those rationales are not really holding water. And it's the largest companies, the biggest companies that have plenty of money that can afford the disclosures that are benefiting the most from some of these exemptions, and not the small companies that are still, in many instances, struggling to raise money. So I trace the kind of arc of each of a number of these exemptions, showing that they started out fairly narrow, but they expanded over time. And so now these exemptions from registration have essentially swallowed the mandatory disclosure rule.
Right. Um, So I think we're going to come back to this a little further down, but
Mm-hmm.
maybe say a few words about why should we care? Why is this important? Why should people outside Wall Street, Silicon Valley, or the world of securities law care whether a large company is public or private? And what, in other words, what disappears when a company can grow to a massive scale behind closed doors? And why does that matter to everyone?
Yeah, I mean, I think there's a lot of reasons that it should matter, but I think, just from a very broad perspective, really pulling back, it's just more and more of the company, of the economy is sort of shrouded in secrecy, and less of the economy is sort of under the bright lights of public disclosure and public accountability. That's sort of like the very big picture. So more and more money is being raised in private transactions. It's going to companies that aren't providing public disclosure. These companies have significant impact on the economy, and investors, regulators, the public just don't have very good insight into what's going on. And then to just get a little bit more specific, by avoiding disclosure, it really allows startup companies to operate in secrecy, and they're able to keep critical information about their operations from investors, from competitors, from employees, and from the public. So one risk or one problem that creates is that it really gives leeway for startups to amass, significant market power while they're engaging in anti-competitive practices and sometimes violating the law. So a lot of startups are operating in regulated industries, but they argue that they are providing innovative technologies, and so the normal rules don't apply to them. And so this freedom from regulatory scrutiny sometimes gives startups an opportunity to gain traction with consumers and then recruit their platform users to pressure regulators to look the other way or to change the law. So we have these startups operating sort of in disruptive industries, and boy, that's really exciting. And we're getting products and services that we like, but they're not being regulated. And sometimes that can lead to, further down the line, a lot of problems for consumers and for the employees and for the public.
Right, including problems like inflation, right, which is huge right now, a huge problem right now, and there are definitely many reasons and causes, but this might be one as well, right? Like that pricing power or that market power that you were mentioning is for sure one of the reasons.
One strategy that we see startups use sometimes is that they'll underprice the market to drive out competitors and to gain market power. But then once they've sort of achieved market domination or market control, then prices start going up again. I think we've seen that a little bit with Uber. There are no more taxis anymore, and now we see Uber and Lyft are getting more expensive than they used to be.
All right. Yeah. Um, Thank you. Yeah, moving on back again to your book and corporate governance, uh, your book argues that startup finance itself has become less disciplined over time.
Mhm.
And how did the rise of founder-friendly venture capital reshape startup corporate governance? And how did the absence of unexpected IPO reduce pressure on companies to build strong corporate governance and real internal controls?
Yeah, so it's a little bit of a complicated story, but we'll start off again with the idea that private markets have expanded rapidly, and there's, trillions of dollars in private markets where they used to be in the billion-dollar range. So now there's gobs of money chasing attractive investment opportunities. So VCs, who are sort of the experts in entrepreneurial finance, are finding that they have to compete with more non-traditional investors. So that would include mutual funds, sovereign wealth funds, corporate venture capital. And so the VCs are now competing with these other forms of investors for opportunities to invest in the most attractive startups. So they're not picking and choosing. They just don't have as much market power. And so that's when, because of this competition, they start to offer funding on founder-friendly terms. So it used to be that VCs had very tight control over the startups. They doled out money in small increments. You weren't going to get more money until you met certain milestones. They had veto power over significant transactions. The founders were, the founder salaries were limited. They were controlled by the VCs. But when the entrepreneurs started having more choice of investors, of course, they would choose the investors that were going to give them more flexibility and more power. So that's when we saw the development of this founder-friendly model. Um, so there's lots of different aspects of founder friendly, but probably the most salient is that founders receive shares with super voting power. So, decisions of the board of directors or decisions of a corporation are based on the number of shares that you own. So it's usually typically one share, one vote. So if you own, 100 shares, you have 100 votes. But founders were getting shares with super voting power, typically 10 votes per share. So that would give them the ability to control the board of directors. And the board of directors is essentially the founder's boss. So they basically are picking the people who are going to be overseeing their conduct. And so now founders are getting control over the board at a very early stage in a startup's life. And of course, that makes it really difficult then for the investors who used to dominate the board of directors to exercise oversight and control. And so VCs were no longer able to discipline or to dismiss either incompetent or misbehaving founders. So that meant the founders could engage in misconduct, mismanagement, and fraud for extended periods of time. And it was very difficult for the investors who used to control the board of directors to displace them.
Got it. Do you see some of these also migrating into public markets? Like it seems like, there's kind of a race to the bottom, and I'm thinking specifically of the SpaceX, IPO that's upcoming, right? Like I saw some reporting that some of the terms, that there are some provisions that, would make Elon Musk basically the board couldn't fire him or something. Is that kind of that story of migrating that race to the bottom to the public markets?
Yeah, I mean, I think that what we've seen happening over the last 20-ish years is that Section 12D used to require companies to go public when they had 500 shareholders or more. That changed in 2012. I've mentioned that already. So Google and Facebook, these are the sort of the new kind of founders, newer model of founders. They didn't want to go public, but their investors did want them to go public. And besides, they were going to have to go public because they were crossing that 500 shareholder threshold. So to sort of encourage them to agree to the public offering, they were told, okay, well, you're not going to have to give up control. You can get shares with super voting power. When you're going to the public markets, you'll have time to continue to build a company, company, build the business without having to worry about pesky investors telling you, you need to start making money more quickly. So that's kind of where this founder-friendly financing started off, but that was just right before the public offering. But after that happened, we started to see founder-friendly model, this dual class model going back to earlier stages of the startup life. So it became more or less a routine once you got to a certain size, a certain level, maybe at the unicorn status, you'd go to the board and say, hey, I'm a great founder, give me control if you want me to stay and work for you. And if you don't agree to this, I'll just go find another investor who will agree to give me control. That was kind of the dynamic. So now we're seeing, since then, when the companies do go public, the founders want to hang on to control, and they're even when they lose voting control, they're looking for contractual control, and that was a big issue in Delaware. That was resolved against the founder, against the controlling shareholder, but some of those decisions have been overturned. So we're seeing more and more the ability for not just voting control, but perpetual control. And I think, the Elon Musk's arrangements under SpaceX are a good example of that.
Got it. You mentioned something that I wanted to flesh out a little bit more. It's just about where does the money coming from for these, in this, for example, for VCs and for private equity. So if you can say a few words about that.
Yeah, so a private investment fund it's basically an investment fund. It's sort of like a mutual fund, but it's exempt from the disclosure requirements and all of the rules that apply to mutual funds because all of their investors are basically wealthy, have at least $5 million or more of investments. So these funds raise money from mostly institutional investors, typically public and private pension funds, university endowments, some labor unions and labor union pension funds, and then wealthy individuals. So they amass a big fund. They raise money, and also insurance companies. They raise all this money. They put it in a big pot, and then they go out in the venture capital part of the sector. They go out and try to find attractive companies to invest in. They usually have a 10-year life. The fund will have a 10-year life after which they're expected to return the money they raised back to the investors with profits. So in the first 3 years of a fund, 3 or 4 years, they're looking for companies to invest in. And in the last 5, 6 years, they're trying to quote unquote harvest those investments, that is, sell the companies or take them public. And we're seeing more and more trouble with either selling or taking the company public these days.
Yeah. Yeah, and that's something I want to return to, but maybe let's stay on the unicorns for a little bit longer.
Hmm.
So I think in your book, also you were saying you connect weekend corporate governance to some of the most famous unicorn failures like Theranos, WeWork, FTX. The problems are with Uber. So can you say a little bit more about what is the through line among those cases? Do you see them as isolated stories of a few bad actors, or as a reflection of something more systemic?
Yeah, I think they're really reflecting the weakening of the hands of venture capitalists, their sort of more hands-off attitude toward oversight of the companies that they invest in. And I think we can really trace it back again to Section 12G, to the sort of this ability to stay private indefinitely, because it used to be that the prospect of an impending IPO, if you're really successful, if you're raising a lot of money, if you're issuing a lot of shares to your employees, you're going to have to go public. So knowing that you have to go public had a disciplining effect on the founders and their investors. And it gave investors a lot of power to say, we're going to be going public soon, so we have to pull ourselves together, and we have to look like a public company, and we have to professionalize, and we need, human resources executives, we need a legal staff, we need compliance teams, we need a strong accounting team. And it was really hard for a founder to argue with that because they knew that this was coming. They had to go along with it. But without that impending IPO, there's really not that source of discipline. And so founders no longer were interested in or willing to invest in systems of robust controls that are designed or had been designed to root out unethical conduct and fraud. And founders face a lot less interference in implementing their vision, whether it's a good vision or a vision that's sort of going a little bit off the rails. So the number of unicorns has been growing, and then we've also been seeing increasing instances of misconduct and fraud. You mentioned FTX, WeWork, and Theranos. I focus on those in my book, but there are also many lesser known examples of significant frauds and failures. So I'll just mention a few. There's Nikola, which was a hydrogen-powered truck company, supposedly. It wasn't, but it claimed to be. Outcome Health, which was a healthcare marketing company. Aussie Media, which is a digital media startup. And Frank, which is a financial aid startup. So and with respect to all of those companies, they all engaged in fraud, and their founders or executives were all sentenced to jail. Some of them have been since pardoned by President Trump. Um, so investors lost a lot of money, but these unicorn frauds and failures also have really negative impacts on employees and consumers and the public as well.
Yeah. And you mentioned this con misconduct, or you mentioned fraud, but um, think also of what these companies can hide for years or let fester in terms of sexual harassment, racist or discriminatory practices. So there is a lot that goes that a lot of that we miss visibility on a lot of things there.
Yeah, I mean, I have a chapter in my book that really focuses on the impact not just on investors, but also on consumers or customers and general public. So with Uber, there's a really negative impact on drivers, including taxi drivers who lost their livelihood. There's the gig worker model, which of course isn't very advantageous for workers, and efforts to sort of fight back against that. The platforms, the companies are just swatting those down. They have so much money, they're able to defeat a lot of these efforts. And then a lot of customers of Uber and Lyft have experienced sexual assaults, and the company's been really good at hiding or covering up how bad that problem is. And you mentioned race discrimination. I looked at Airbnb, and they have problems with race discrimination with respect to users of their platform. They're not paying taxes necessarily, so communities, states, cities, local governments are losing a lot of tax revenue because they're saying they're not hotels. They don't have to pay the occupancy taxes. And then they also have had lax security standards, which have allowed things, lots of problems, crazy parties, violence, sexual assaults, and things like that. And they're very good at sweeping it under the rug because they have arbitration agreements where they can't go to court. They have to settle quietly
Right.
with Airbnb. So there's just
Yeah.
a few examples I could go on probably for another hour, but I won't.
Yeah. Okay. Um, we're getting some questions on the chat that we'll get to at the end, but
Okay.
there is one that maybe you can talk to about now. There's a question about whether any venture capital firms have gone out of business in Silicon Valley, and
Um,
and maybe I'm thinking like why asking that now in terms of like these companies are backing making these massive investments in some of these unicorns, and we saw Theranos or WeWork that basically blew up, and did the VC suffer big enough losses?
well, they're diversified, so they'll have 5 or 10 investments, and they're just counting on one or two of them to really be a home run. And some of these unicorns that have imploded were the ones that they hoped to be a home run. I think FTX is a good example. They raised $2 billion. All of that money has gone up in smoke. But the funds, if they do go out of business, if they do wind down, they do it very quietly. It's a very competitive business, so there's lots of VCs out there. Some of them are very successful. Some of them are less successful. The ones that are less successful are the ones that are going to wind down. The ones that are very successful, if they've hit those home runs, it's easier for them to raise money in the future. So there's a very much of a skewing towards the top, where the top VC funds can raise, multi-billion-dollar funds, and some of the other smaller ones who focus on the seed rounds, the early rounds, are having trouble raising capital because the amount of capital going into VC and private equity has been going down over the past couple of years.
Yeah. And yeah, I think we'll talk a little bit more about that in a second. But you had a new op-ed yesterday, I think, on Bloomberg,
Yes.
warning about the dangers of opening up 401ks to private markets and to all of these risks that you have been mentioning. And right now, the Trump administration is proposing a new rule through a DOL that would open private markets to retirement savers with defined contribution plans like 401ks. Um, can you talk a little bit about, what you said in the op-ed and what is wrong with the idea that workers are missing out in their 401ks unless they gain exposure to private equity, private credit, or venture capital?
Yeah, I mean, it's an issue that I'm very concerned about. That's one of the reasons I wrote the op-ed. But I would say, just in terms of this idea that this is a great opportunity for retail investors to invest, like the rich people. Really, even the most enthusiastic backers of private equity have conceded, at least in the most recent years, that private equity and VC investments are underperforming on the broad indexes like the S&P 500. And private credit has been delivering pretty strong returns, but now, recently, in the last 4 or 5 months, um, the private credit funds that have been marketed to retail investors are facing a crisis in confidence for a number of reasons. I go into those in my op-ed. So investors are trying to pull their money out, but those investors who are trying to get their money out of these private credit funds are facing liquidity gates. And what that means is that the private credit funds are limiting the amount of cash that they're going to return to investors to 5% generally of the fund each quarter. So even if they receive redemption requests for as much as 40% of the fund, those investors only get, a proportional allocation of the 5% that they're willing to return in that quarter. And private fund managers, Apollo, Blue Owl, Morgan Stanley, and many others have all imposed limits on their investors' access to the fund. So this argument that private markets would provide attractive investment opportunities for 401k investors really doesn't hold water at all, at least at this point in time. I mean, they have other arguments about diversification and other things like that, but those are not very strong arguments either. And of course, not just is it underperforming the market, we're not even taking into account issues like the lack of transparency. There's just not a lot of information. How is a regular employee who's investing in the 401k supposed to know? Do I want to invest in this type of investment if they don't have any information about it? There are problems with liquidity. We're seeing liquidity problems in private credit. So if that's in your 401k and you want to get your money out, they might be able to say, sorry, like not now, come back in 6 months or come back in another quarter. Whereas you need your money because you're changing jobs or because you're retiring or because you have an emergency, you want it now, you don't want it in 3 or 4 months. And then there's the issue of valuations. The evaluations are subjective. They're determined by fund managers. The valuations are most likely inflated. That's why in private credit, people want their money out. They think those valuations are inflated. And then the fees are very high. So for all of those reasons, these are not really appropriate investments for 401k investors. And we mentioned pension funds. We mentioned um, university endowments that are the big investors in private equity and private and venture capital, and they're trying to get out. They're facing the same liquidity problems that the private credit investors are facing. They need cash. They need cash because of their struggles with the Trump administration, and many of them have had to sell their private equity investments at a discount in order to get the cash that they need. So the people who have been propping up this market are now seeking to get out of it. And I think that's part of the reason that they're saying, wow, there's all this money sitting in 401ks. If we're not going to get more money from pension funds and university endowments, maybe we can get our hands on some of that money.
Sort of a bailout, right? So sort of like bailing out a struggling industry. It seems like private equity specifically has a lot of overvalued assets, like you said, a lot of companies that they bought at the peak of the frenzy in
Mm-hmm.
2020, 2021,
Exactly.
and that now they can't get rid of them unless they, sell them at a lower valuations.
Right. And if once they start to sell assets at a lower valuations, they have to mark down all their assets. And so it starts to become a house of cards. And so um, if they can put them into 401ks at the current valuations, the inflated valuations, then they don't have to write down their other assets.
Right. And beyond that, beyond the private equity, even in this, in the larger thinking, big picture of private markets, there are also like big asymmetries between investors, right? So like even if you can get access, as a retail investor or as a retirement saver, even if you get access to these private markets, you wouldn't get the same terms as a, big institutional investor, right? You wouldn't get the same opportunities, right?
Right. I mean, the best opportunities are the best companies aren't looking to, private markets. I mean, sorry, retail markets to raise money. So there's a concern that there's going to be an adverse selection problem, so that the types of assets that go into the 401ks aren't going to be the most attractive assets. They're going to be the ones that are sort of the less attractive assets. So that's one concern. And then generally in the private markets, there's information asymmetries already. So the biggest pension funds sometimes get better deals. They get better access to information. They know more. They are better able to assess values, where the smaller pension funds aren't getting the same information or don't have all of those extra rights. So even within the markets, there are information asymmetries, and there's not equal treatment for all of the investors. But the 401k investors, the people negotiating on their behalf most likely are going to be the trustees of these 401k plans. Those trustees are not full-time investment professionals. They're typically either human resources or attorneys, and so they're doing the best that they can, but they're just not a really strong match up against the professionals, the consultants that are going to be pushing these products on them.
Right. And then the other problem is the fees, right? It's like these are really relatively more expensive investments options than, for example, a public index, right?
Yeah, I mean the cheapest option for 401k investors are index funds, broad-based index funds. The fees are very low. There's a lot of competition. They're under a lot of pressure, and the fees have been going down year after year. And it's very hard to beat the market. So it's very hard for a manager that's an active manager to outperform, for example, the general market, the S&P 500. So the cheap, and also people say, and professionals and personal finance professionals say that, the best way to preserve your assets is to reduce the fees. Trying to asset allocation, stock selection, and all of those things. People have found that it's the lowest fees that are the best way of preserving your assets. So where I guess they're going to be target date funds where they come in and they bring in private assets. Their fees are going to be higher than the typical target date fund. The funds so far aren't disclosing what those fees are going to be, so we don't really know. And they're going to be in this new type of investment vehicle, which is called a collective investment trust. And there's not as much transparency around fees or investments and for CITs as there are for mutual funds.
Yeah. Yeah, I think the fees are a huge concern. Just like a couple points difference can make a huge
Over
difference
time.
over 20, 30 years that people are
Exactly.
saving for retirement. It can amount to, maybe hundreds of thousands of dollars less over 30 years. Yeah.
Right.
So we want to leave a little time to get some questions from the audience, but can your book also, not only talks about these problems, but also you offer a reform agenda. So if policymakers wanted to restore a healthier balance between public and private markets, where should they start? What are your recommendations?
Right. So the last chapter of my book is basically focused on laying out a roadmap for reform, which would sort of restore a better balance between public and private markets. And without getting too bogged down in details, I really focus on ensuring that investors have access to adequate information when they're making investment decisions, whether they're investing in public and private markets. And to get a little bit more specific, I focus on four key areas. So one is Regulation D, and this is a safe harbor exemption that private funds and private companies rely on when issuing securities. Almost all of the $4 trillion that's raised in private markets each year is raised under Regulation D. So I have a set of reforms about how to improve Regulation D to ensure that investors are adequately informed and that their interests are protected. I also focus on Rule 701. And Rule 701 is the exemption that startups rely on when they're issuing equity interest to their employees. So most startups have a model where about 20% of the equity of the company, the stock of the company, or at least an interest in the stock of the company, is going to their employees. And the employees are that money, the value of that money is really tied up until the company achieves an exit. So I argue that we should expand the disclosure requirements under Rule 701 so that employees can make informed decisions when they're investing in stock, exercising options, and employment decisions when they accept a position, when they accept a job, or when they decide every day whether to continue to work at that company. I also look at Rule 144 that covers resales of private company shares, and I look at the rules that govern private trading platforms. So they're platforms that have developed outside of the public markets where employees and early investors can sell shares. But the way that those markets work, there's not necessarily good disclosure, and there's problems of information asymmetry, potentially insider trading within those markets. And then finally, I focus on Section 12G. Again, that was the rule that used to require large companies to go public when they reached 500 shareholders. So I look at the statutory provision and also the SEC rules under those provisions to sort of help to ensure that all large companies with a significant shareholder base are required to make public disclosures to the SEC and to the public.
Thank you. So I think we're good to turn to questions from the audience,
Okay.
or is there something else you want to cover, something I didn't ask?
I think we've covered pretty much the whole book.
Yeah. Yeah,
Well,
so we're
there's more to read. So yeah, we haven't covered everything.
yeah, there's more in the book for sure. We're getting some questions that are more, historical, like
Sure.
whether there were some uh, presidents that were more responsible for this financial deregulation, or whether there was a strong opposition to the deregulation of private markets that you talked about. So,
Yeah, so I would say it's been a steady trend of deregulation since the 1980s. I would start there. I would say that the statutes that I mentioned as sort of being the most significant, that was NISMIA, that was 1996, that was under Clinton, and the Jobs Act, that was under President Obama. So it's kind of equal opportunity bipartisan deregulation. I would say that, unlike Sarbanes-Oxley and Dodd-Frank, which everybody's heard about, most of these changes are flying under the radar and people aren't paying attention, and they're small incremental changes. And, we don't really necessarily see the impact of those right away. And so um, it's like almost, I wouldn't say it's stealth, but it's almost like stealth deregulation because it's like a thousand little cuts. It's not one big sweeping, let's deregulate all the markets. Now we're heading into that direction now with the make IPOs great again proposals, but I think most of these things most people didn't notice when they were happening. It's a lot of technical changes to the law.
right. Um, we're getting some questions that are more about investment advice, which I don't think we can we
Don't
can
take
do.
advice from me now.
No, but we can maybe talk a little bit about and you already talked a little bit about it, but like one of the questions are about the lack of transparency between public stock markets and government bonds and private equity. So, is there anything else to say about that?
Yeah, I mean, I think the lack of transparency is an issue not just for like, oh, we're going to put this into the 401ks and retail investors aren't sophisticated or they can't afford to absorb the losses. The lack of transparency is already a problem in private markets. I think that the institutional investors or the bread and butter investors in these funds are very frustrated by the lack of transparency. They don't necessarily feel like they always have a good understanding of fees, the fee structures, the way these companies are managed, the way the funds manage the companies, the valuations, and all of that. So even without sort of bringing retail investors in the market, there are still lots of concerns with information asymmetries. The funds know a lot more than the passive investors. They're called limited partners or LPs and limited partners. They want access to the very best funds. And since they want access to the very best funds, they're often very reluctant to rock the boat. And so they're willing to accept, a little bit more opacity with respect to what's in the funds and also the fees um, than they probably would if they weren't afraid of being iced out, for example, of the next fund. And then with respect to VCs, the venture capital sector, that's what I really focused on. One of my big concerns is due diligence failures, where VCs, we think that VCs are like looking at these companies very closely and that they're, you know, verifying everything that the founders are telling them and that they're not going to invest unless they're absolutely assured that, this founder is responsible and that the company is doing what it says it can do and that the products work. For example, Nikola, the product didn't even work. VCs just still poured in billions of dollars. Theranos, the product never worked. And the investors and the directors, when they were told about it, they just didn't believe it. They didn't want to believe it. So that's another big concern I have that, venture capitalists aren't providing the due diligence, the oversight that really the whole venture capital financing model depends on. And so we're seeing, more and more instances of fraud. And then when the fraud is revealed, it turns out, well, the VCs were never getting the financial statements or there was never a CFO and the VCs knew that, but they still invested in the company. So there's just this, it's kind of hard to understand this kind of hands off, fingers crossed mentality that seems that many VCs seem to have adopted.
There's a question related to that. It says, can you talk about how the fiduciary might assess these various assets when making recommendations? So it would, yeah, I'll let you address that.
Well, when you're talking about like the fiduciaries, the trustees or the of a 401(k), for
That's what
example.
I think the question, yeah,
Yeah, I mean, I think they're just at a distinct disadvantage in exercising those fiduciary duties because they're dealing with a fund manager. The fund manager then deals with whoever the private equity managers are who are bringing in these assets that they're going to be embedded into these target date funds. So the fiduciaries might know a little bit about the target date fund, but not necessarily a lot about the underlying investments. And, the fees are going to be blended fees. There's just a lot of it's a lot of complex information that's very hard to understand. I've already said that the LPs are sometimes flummoxed by a lot of what's going on. So I'm not sure that these human resources, these lawyers are really well equipped to sort of square off against the private equity managers and the consultants that are helping them to market these products.
thanks. Um, I see that there are also some questions in the chat, and not just the Q&A box, so I'll go there in a second. But let's just take one more from the Q&A box. There's a question about if you can speak more about the incentives for cost cutting, layoffs, and excessive executive compensation. I think, maybe we can take that from two angles. Like, if not sure if the question is about private equity, where there are a lot of incentives for cost cutting and layoffs, and particularly because of the use of debt when they acquire companies,
Hmm.
and executive compensation. But so that's one, and then I don't know if there is another angle from the corporate governance and VC side, but I'll let you.
Yeah, I mean, one of the biggest criticisms of private equity is that they load up on debt, and then that puts a lot of pressure for cost cutting, and or maybe selling the most company's most valuable assets, and then the companies in many instances the companies end up in bankruptcy. I think Toys R Us is sort of a quintessential example of that. There's also concern about, the level of services that a company will provide to its customers after it's acquired by a private equity firm, again, with the interest of cutting costs. And so we've seen some reporting about, for example, the healthcare industry. So hospitals, elder care, assisted living, there's some studies that show outcomes are much lower or much worse for health outcomes, that is, for private equity owned hospitals, nursing homes, assisted living facilities than they are for privately owned or nonprofit facilities. And so there's definitely a sense that this cost cutting mentality is having a negative impact on consumers and ultimately on the public. In VC, I think we sometimes see the opposite. There's just this wild amount, really wild and insane and irresponsible spending that's going on as in the boom times as companies growing and the VCs are really focused on revenues and revenue growth. It's kind of a growth at any cost mentality, and it's a little bit hard to rein in, you know, a founder who has control and is in control of billions of dollars, and they want to spend it however they want. And so, we've seen instances of overspending. I think WeWork's a very good example. Uber's another good example. I think maybe Theranos is the quintessential example where they paid for reportedly, all of Elizabeth Holmes' expenses, her rent, her clothes, her private jet, security, all of these things are all being paid for by this company that still hasn't even achieved any profits.
And FTX too, right? Like there was like some huge, like crazy spending there.
Oh yeah, they were buying luxury real estate in the Bahamas for all of the executives and their family members and all of the campaign contributions. Many of them were
Campaign
illegal
contribution.
campaign contributions and then quote unquote charitable contributions, all with basically money that customers, entrusted to FTX to supposedly invest in crypto, but it was just being transferred to this affiliated firm that was then just, misspending those assets.
Well, there's another question about private equity, and it's about the debt that you were mentioning, and how is the PE firm not responsible for the debt of the subordinated firm? And it's a two-part question. And then how can the subordinated board act in ways that would normally violate their fiduciary responsibilities to the investors. So I'm guessing that the board is for the portfolio company, which you can talk a little bit more about that.
Yeah, I mean, the way that private equity is structured, and again, my book's not about private equity, but it's so closely related that like you have to kind of look at them together. But a private equity firm will say, oh, we're the fund is going to take over this company and they're going to buy the company, and they're going to do it with borrowed funds, and then they use the company that the target company's assets to secure the loans. And the target company is the borrower, not the private equity firm. And that's why it can be profitable to use debt to buy a firm in private equity, cut costs, charge lots of fees, distribute cash to investors because you've sold a lot of the underlying assets, and then drive that entity into bankruptcy. But still, the private equity fund and their investors are making money. So there's a model with some misaligned incentives. It's been, some people think it's a great model. A lot of other people think it's a defective model. But there's definitely, I guess you would call them, serious externalities embedded in that model.
Thanks. Um, Time for a few more questions. So I think this is a good one. If more disclosures were required on the Reg D and some of the other rules, do you think retail investors would be able to understand the information? Will they need help or have help?
Well, the way things are now, I mean, investors don't know everything. They don't read everything, but the all that information is filtered by investment professionals, by investment advisors, by the press. So we're all benefiting from information that's disclosed by companies, even if we've never picked up a 10K or a proxy statement or a 10Q. Well, they're not going to be 10Qs anymore, a 10S maybe in the
We
future.
hope there are.
So yeah, I mean, more information helps everybody, and it's not just investors, it's regulators, it's the press, it's academics, everybody. There's quote unquote positive externalities from disclosure that's not just benefiting investors or the company. So under Regulation D right now, to get a little wonky maybe, Regulation D is an exemption that, as I said, almost all the money, almost all the $4 trillion that are raised every year by private companies and private funds is raised under Regulation D. And under Regulation D, this Rule 506 to get even more wonky, you can sell an unlimited amount of securities with no disclosure at all as long as every investor is accredited. And the accredited investor standard has been watered down just by the virtue of inflation. And so a lot of these transactions are occurring with no information disclosed at all, either to investors or to the public. So there's a form that companies have to file, supposedly, when they sell securities under Regulation D, but in at least half of the transactions, the companies aren't filing that form. So even the SEC doesn't have very good insights into this market. So one of my proposals is to, amend Form D so that it's more inclusive, includes more information. And then if a transaction is extremely large, like I think I said 200 million in the book, but that's kind of a random number, then there'd be more disclosures required to investors, regardless of whether they're accredited or not. And the thought is, well, it's not like a cost barrier at this point to prepare those disclosures and get audited financial statements. And there's, anecdotal evidence that in a lot of these transactions, some investors or maybe even all investors aren't getting information. And there's lots of evidence that the information that they are getting in many instances isn't reliable, either because it's not audited or the audits are ineffective.
Thanks. All right, we'll take a couple more. One question about unicorns. Are most unicorns tech companies, or is it concentrated in certain industries?
I mean, mostly they're tech companies, and for a long time it was mostly platform companies. I mean, SpaceX is a good example. It's been private for I think 19 or 20 years. It's going public in the next couple months. Next month, I'm sorry, it's going public next month, as supposedly a 1.5 or 1.75 trillion dollar valuation. So most of the unicorns are tech companies, but there are also other like big companies that aren't tech companies. Sheen or Shine, which is a clothing company, is one of the unicorns. So they're in various sectors. I think WeWork was another one. It was a real estate company essentially, but it's very much concentrated in tech. And now it's almost all AI. Almost all the money, more than half the money of VC investments last year went to AI affiliated firms.
Going back to the 401ks,
Hmm.
to the proposed rule, uh, have you seen any studies that are not from industry about whether investors really want more access to alternative investments?
I mean, we know that just generally speaking, there's some numbers, I think I have them in the book, that, there are very few, the percentage of Americans who have any kind of equity at all is relatively small. And of that amount, the amount that are on direct stocks, stock directly rather than through mutual funds is even smaller. And then, of course, of that, like probably a minuscule amount of that is invested in private markets. It doesn't seem like there's a demand at all from investors or retail investors for these investment opportunities. I'm sure there are some who want them, but most people probably don't even think about it. And the push, it's a supply problem. It's not a demand problem. The push is coming from industry, and they're trying to convince everybody that there's this great opportunity out there that they're missing out on, and we should all invest like pension fund investors. But they're leaving out the fact that the pension fund, if you have a pension and your pension fund is invested in private equity or venture capital, you're not going to shoulder the losses. The fund is going to shoulder the losses, or the fund sponsor, or the state, or your employer is going to shoulder the losses. And so, if they make a mistake, if they make a bad investment, it's not going to hurt the employees. Where it comes to 401k money, if there's a mistake, if there's investment, if there's significant losses, the individual workers are going to shoulder those losses. And I think the industry is just sort of eliding over that really important difference.
All right, maybe we'll take one more. There's a kind of longer question. I think it boils down to a couple of companies that made at least 100 million dollars a year that couldn't find any investment bank or small stockbroker that could sell them an IPO in an IPO. So the question is like those small brokers no longer exist, and this person believes that the reason is too much regulation. Could you respond? I think we talked a little bit about that, but anything else to say?
Yeah, I mean, it is true that the sort of small IPO has more or less gone by the wayside. There are lots of reasons for that. I think one of the reasons is that their private markets are just so much bigger. Mutual funds are waiting for companies to be bigger to invest in them because the funds have more money to invest, and they want to make more big investments at one time. And mutual funds are now investing. They're not waiting for the public offering. They're actually investing in unicorns. And so there's been a shift of, mutual fund money, which is the money that where sort of a lot of ordinary investors put their money from public markets into private markets. And then there's no requirement for an IPO. So there's not those smaller companies that have to go public. And so there's just that part of the market's more or less dried up. Yeah, I agree with that.
All right, I think that's a good place to end.
Okay.
Professor Johnson, any final thoughts before we close out?
No, I just want to thank you for giving me this opportunity to speak about this topic. And I think it's very important to shine attention on this topic at a time where there's a strong effort for additional deregulation. A lot of those policy proposals are based on arguments that really don't hold up to scrutiny. And I think it's really important for us to step back and think about, not just what is the reality, but what are the legal reforms that are behind that reality, and to address the reforms that actually contributed to the shrinking of public markets in order to sort of, I don't know, what would you say, right the ship, so to speak.
Well, thank you so much for such a thoughtful conversation and for being so generous with your time and taking all those questions. And thank you all for everyone who joined us today. I hope this was as informative to all of you as it was to me. And remember to keep an eye out for the book on Tame Unicorns, Why Startup Finance is Broken and How to Fix It, which will be out on August 4th. And you can also visit AFR's website at ourfinancialsecurity.org for more on future events with our guest speakers. Thank you all for turning in, and have a good day.
Thank you.